Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a regular, haven't had him on in a while, but with all the turmoil in the markets, with these big, downward moves, and then they bring it up, and then boom, the next day it sucks down again, and then it's gyrating all like a roller coaster. I figure it's a good time to bring on Michael Pento of Pento Portfolio Strategies. Michael Pento, expert, money manager extraordinaire. What's going on in the markets? Why the roller coaster ride?
Great, thanks for having me back on again. Well, I guess a lot of this has to do with trade. I have a model, a 20-point model, which I use to divine where the economy sits along an inflation and deflation, deflation spectrum. But I got to tell you, trying to model Trump's Twitter handle is impossible. So, up until a few days ago, everybody thought that, hey, Donald Trump cares about one thing and one thing only, which is being reelected. So what he'll do is he'll have a very superficial deal done with Xi Jinping, and he'll have them import some more soybeans from the United States, which will attenuate the trade deficit a little bit. And then China will promise to try harder on their intellectual property theft, and they'll try to reverse some of their architecture in their country, which is derived from the government owns state-owned enterprises, and these are obviously beneficiaries of massive subsidies. So they'll try harder to, rewire the whole economic structure of China, and they both can declare victory, and everybody goes off into the sunset, and the stock market can continue on its merry way to record highs. But then all of a sudden on Sunday, we have a tweet from the president saying, "Hey, this is not going too well, and I'm not really worried about the stock market, and I'm not really that concerned about being reelected. What I really want to do is change the relationship between the United States and China." And I got to give Trump some credit. I will criticize President Trump when he deserves it, and he deserves it often, even though I voted for the man. Let me get that on the record. He is correct. I mean, we have a $420 billion annual trade deficit with China. In other words, the U.S. buys $420 billion more of goods than we export to China. And guess what that means? That means we are selling away pieces of our country bit by bit. So we send them dollars. Chinese consumers and government takes those dollars and they buy U.S. treasuries, or they buy capital in the United States. So we have a capital account surplus. That's what they call it, a capital account surplus. But really, we're selling and mortgaging our future to a foreign power, one that's completely communist and dictatorial. That's not a good idea. And by the way, that $420 billion trade deficit represents jobs in the United States that could be here, but instead are in China. So I give Trump a lot of credit. The question is, and you can't model it. You have to just ask yourself this question: how do you feel? What's your gut instinct? Does Trump align himself with Treasury Secretary Steven Mnuchin, who again just wants a deal done? That's all he cares about. Or does he align himself with Lighthizer and the Navarros in the administration, where they say, hey, this is a communist dictatorship, massively armed with nuclear weapons. They are a very huge competitor to the United States, and we need to address the situation in the long term.
Well, they just unveiled their latest aircraft carrier. They have a third aircraft carrier now, so they're not positioning themselves for peace, love, and happiness, and beating their swords into plowshares. They got a third ultra new modern aircraft carrier. They got enough money to spend on that. Do you think we're in the correction mode? I mean, we're headed for it. We're not in the correction, obviously. It's 20% for that. But do you think we're headed back to November and up until Christmas Eve, December of 2018? You think we're going to get another 20%?
Before I answer that, let me just expound on that with your last statement you just made. And through their Chinese Belt and Road Initiative, what they're doing is they're engaged in these projects with other nations. Even Italy is engaged in some of these loans that have impossible covenants, And when these countries default on these loans to China, China ends up usurping or annexing parts of these nations. So this, let's hope. I kind of err on the side of being with Lighthizer and Navarro, even though I'm not a neocon by any stretch of the imagination. The great people of China, please don't conflate what I'm saying about the great people of China with the communist government of China. But they have a vision, a long-term vision to take over great portions of this world and make it into a communist dictatorship. So the fact that the U.S. administration under Donald Trump is finally trying to stand up to the Chinese, I laud him greatly. Now, you asked me if this was a continuation of the October to December plunge in the stock market, where the Russell 2000 lost 30% in a matter of weeks. And for 41 days, the entire junk bond market was frozen solid shut. Not one bond was issued in that entire tenure.
Wow.
So make no mistake, Greg, we were headed for a 2008 depression in October, November, December of 2018. That was truncated, that was cut short by two things, in my opinion, possibly three, but primarily two. The Fed's, obviously, the 180-degree turn on the central bank of the United States, from raising interest rates from 2.5%. Remember, they raised in December, which really sent the stock market plunging. They said they weren't going to raise rates from 2.5% to 3.5%. They were headed towards 3.5%. That's what Powell said. I want to be 50 basis points above neutral, which the average neutral rate on that dot plot was 3%. And he was going to stay there for some time. And remember, the balance sheet reduction was on autopilot. It was like going to be watching paint dry. And then when the market collapsed, which is the primary, by the way, the primary mandate of the Federal Reserve, in case you were confused, the primary mandate of the Federal Reserve is to keep asset prices in a perpetual bubble, an ever-expanding perpetual bubble. So when that went wrong, the Fed turned on a dime. And they also said that, by the way, the balance sheet is no longer on autopilot. It's actually going to be wound down instead of taking it from $4.5 trillion on the central bank's balance sheet of the United States to $3.5 trillion. We're probably going to stop closer to $4 trillion. So they turned tail and ran. The other thing I know what happened is that China's stimulus went into high gear. I think they issued, my memory serves me correctly, in January was a record amount of debt, over 4 trillion yuan worth of debt. Now, this is from a nation whose debt has quadrupled since 2007. So you have those two factors going, and of course, the Trump did not escalate the tariffs. So a hoped for rejuvenation in a sustainable fashion of China, which, by the way, is never going to work. And this big change in central bank policy on the part of the United States. So that's why you have no one who manages money is God. They are wrong many, many times. That's why I developed this model. The model is based upon data and math, incoming data and math, which tells me when we're going to head for another crisis like we had in the fall of 2018. So I'm watching LIBOR.
Are you seeing that?
No, not right now, not imminently. Now, this correction is the correction you're seeing in the market this week came from Donald Trump's Twitter handle on Sunday night. Period. End of the story. Because I do not see LIBOR rates rising. I do not see high yield bonds falling in price. I just don't see it yet. It's not there. I have I've been in the business since 1992, and I'm no Cassandra, as you and your audience well know. I will tell you when it's time to get short the stock market. It's just not time to get short right now, because those high frequency data points in my model, which, by the way, can change on a dime. They changed on a dime in January, and they could change on a dime in a matter of a few days. By the way, as of this recording, this is being recorded on Tuesday. As of this recording, those super high frequency components of my model have started to turn, but it's only one day. I have a trend of a couple of weeks, at least a couple of weeks before I make a change in my portfolio. But LIBOR rates are rising today. The high yield bond market prices are crashing today. And if Trump goes ahead with these tariffs, I would anticipate that these high frequency components will continue to signal that it's time to get short the market. So it all depends on Donald Trump. But and again, you cannot model what Donald Trump is going to do on Friday at 12:01 a.m. You just can't do it.
With the Chinese, what do they have to lose? I mean, you said something like they increased their debt in 2 decades by 20, or is it 30 trillion? I mean, it's an unbelievable amount. They increased their debt by how much in what amount of time?
So since 2007, the Chinese government, the communist Chinese government, has increased its debt 4 times, fourfold, since 2007. They're at $40 trillion of debt.
So let me get this straight. They were at 10 trillion.
Yes.
And now they're at 40 trillion.
40 trillion.
Wow,
40
what could go wrong?
And that's not me. That's the International Institute of Finance. I mean, I don't calculate these numbers myself. Wow. I don't pull these numbers out of my hat. Okay. So what happens is with China, is that China, after massively they pulled their economy out of the doldrums in the year 2000. That after our NASDAQ bubble crashed. Then in the Great Recession, which was nucleus was our real estate bubble, they went on a massive stimulus project, which brought that debt up to $40 trillion. This debt was $2 trillion in the year 2000. Now it's $40 trillion. Wow. Okay, $40 trillion of debt. And then in January alone, they printed and shoved into the Chinese economy, the PBOC and the Chinese government, over 4 trillion yuan in 1 month, a record amount of debt. So, and by the way,
I'm sorry. Why China could go bankrupt? I mean, if
their currency is teetering on a collapse. It truly is. In my opinion, they have by the way, China has a current account deficit with the rest of the world. They have a surplus with the United States, but they have a deficit with the rest of the world. Their reserves have dwindled from 3 trillion to 1 trillion in currency reserves. And now they've gone in these various iterations of massive debt issuances. So like I said, it was $40 trillion. And why did the Chinese economy start to collapse? The Shanghai Composite peaked in the year 2015, and then it collapsed some 30%, is because even the government of China said in the fall of 2018, hey, we have to cut back on our stimulus. And what happens when the government of China cuts back on stimulus is the stock market craters and the economy starts to tank. I mean, I think not the 6%. I'm not talking about 6.5% to 6.4%. I think the Chinese economy was not growing at all towards the end of last year. So what does the Chinese economy do? Force more loans onto the over-leveraged debt dung pile that is owned by the People's Bank of China and the Chinese government. That's what they do. So here's the point, Greg. This is such a salient issue that I hope to get across to people. There is no free market anymore. Sorry. The free market does not exist any longer. Let's just turn to, we just talked about China. Let's just turn to Japan for a second. The Bank of Japan now owns over 50% of the entire Japanese government bond market. Over half. The entire Japanese government bond market is in the possession of the Bank of Japan. And not only that, but the Bank of Japan owns over 80% of the entire ETF market. Now, Greg, there is no escape. Central banks cannot ever escape from their massive intrusion and evisceration of free markets. For if they did, the entire economy would collapse. Let me quickly turn to the United States, where total household net worth is now 535% of the economy. So your stocks, bonds, and real estate are the primary components of that. It's 20% higher than it was at the peak of the NASDAQ bubble. That's why the Federal Reserve can't get off any higher than, it went from 0 to 2.5% on the Fed funds rate, and then drove the entire economy into free fall. The economy was in free fall in the fall of 2018. The stock market absolutely cratered. That's the truth. That's a fact. And as I said, the junk bond market, no more issuances of junk bond market in the junk bond market. And by the way, when corporate debt has surged to, let me just give you some perspective. So the subprime mortgage crisis, the total amount of debt at that time, just 2008, late 2007, early 2008, was $1.5 trillion of subprime mortgage debt. Well, if you add up junk bonds and leverage loans and triple B debt, you get $5.4 trillion of basically insolvent corporate debt, which would become completely and known to the world to become insolvent if we have a contraction of any kind of GDP. That's where we're headed in the fall of 2018. Not too many months ago, Greg. So what I'm trying to convey to you and your audience is that central banks have gone all in, and they can never stop printing this money. Fiscal support, massive amount of deficits can never stop because the free market has become eviscerated. And one more point, and I'll let you get in here. I know you will probably have a couple of questions.
I'm enjoying this.
So the total market cap of equities right now, I come on your show often and always mention this, is now 145% of GDP. That's flashing bright red, and one of the components of my model, by the way. So the average of that ratio was 60%. And from this 1975 to 1995, it was about 60% of the economy. So when the total market cap of equities, when the price of, think of it this way, the value of stocks is only half, and I'll say only half, of the entire GDP of our nation, you know what? You can have a bear market in stocks, and it isn't such a big deal. But when the total market cap of equities is 1.5 times the entire productive capacity of the United States in a year, then you cannot have a bear market, because it's stocks that lead GDP. It's the value of equities that lead the economy. So if they fall, they bring the entire economy down with it. That's where we are, Greg. We're in a condition where central banks have across the globe permanently monetized $14 trillion worth of debt. What does that mean, monetized, Mr. Pento? That means they printed money out of nothing, ex nihilo. They printed money like a counterfeiter would. They bought assets, and they said, you know what? Governments, people, corporations, whoever they bought, we're good. You don't need to worry about this debt. It sits on our balance sheet, and it will never leave. And you know what? The government says, thank you very much, because I don't have to pay interest on that debt like I would if the public held that debt. But there's no escape from that. And that's why there's $10 trillion worth of negative yielding sovereign debt around the world. So when people tell me, and they probably tell you this, they probably, there's some people who listen to this and say, hey, Mr. Pento, why are you such a Cassandra? Why are you so down? Don't you know that the stock market's doing great? And don't you know that I have a job? But here's the thing. The entire edifice, the entire construct is artificial. It is controlled by governments and central banks. And hence, it is much more fragile, infinitely more fragile than if it was dictated by the free market.
How does this, people are sitting here going, okay, so this has been going on for a while. They've been doing this since 2008. You got a dead body and you got an iron lung and you got something, blood pumping in there. It's the central banks, right? So when does that just stop? When do you hear, doo?
Well,
when does that happen?
It happened, people forget, again, it happened already in the fall of 2018. It was only taped over with masking tape and rubber bands and glue for a little while. But there are two things. Remember, this construct, this edifice is completely artificial and fragile, making it much more fragile than if it was supported by the free market. But here are the two things that will break this bubble. Number one is inflation. If we ever get inflation to run hot, in other words, if long-term interest rates, which are no longer being controlled by the Federal Reserve, if they start to run hot and become intractable, then this whole thing blows, because the whole valuation metric comes crashing in, and it will look like 1987, Greg. We will have a stock market. Of course, there's circuit breakers now that limit it to, I think, 10% in any one day, but then it opens up for a minute and drops another 10%. So we're gonna have another 24%, like we did in October 1987. We're gonna have another couple of days like that if we ever get inflation running hot. And by the way, central bankers around the world are so damned intent on generating this 2% inflation target the way they measure it. By the way,
what's the other thing? What's the other thing that can knock this thing off?
I'm sorry. Yeah, thank you for getting me back on track. The other thing is a recession. A recession which caused a protracted decrease in earnings per share. So we are going to have Q1 2019 earnings per share on the S&P 500 is most likely going to be negative or very close to zero. But don't you know that Wall Street's hockey stick of EPS growth shoots up, dramatically in Q3 and Q4 of this year. If that doesn't happen, then at 145% of GDP and trailing 12-month earnings at over 19, then the stock market's going to crater. So that's the other thing. We get a genuine contraction of earnings per share, which is derived as a derivative of the economy, of a recession, which could come from Trump's tariffs, rightly or wrongly so, but I think rightly, on China. But don't forget, the Congress has yet to ratify the trade deal with Mexico, USMCA. That has not been ratified. And even if we don't put tariffs on China to the tune of 25% on all of their exports to the U.S., which is $500 billion of exports to the United States. Even if we don't do that, we still have that threatened tariff with the European Union on autos and on Mexican cars if they don't stop drugs coming into the United States by the end of the year. So there are recessionary components to the economy. And by the way, let me just say this too. So many things in my head that I want to get out to your audience. Normally, in most cases, let me just say this. Even if we don't get any tariffs at all, that doesn't mean the stock market and the economy has a green light. Because in most cases, when the Central Bank of the United States raises rates by 400 basis points, we get a recession. You think about what happened between 2004 to 2006. The Fed raised rates from 1% to 525 basis points, 5.25. So 425 basis points caused the yield curve to invert and the economy crashed. Well, the yield curve did invert in Q4 2018, and the Fed raised rates 9 times. So they raised rates to 2.5%. That's not quite 400 basis points. But if you look at shadow rate statistics, where the Fed funds rate was, it was at -3%. Okay, so that's according to shadow stats. So if you add 3 to the 225 basis points, right, you get 525 basis points from, remember, ending QE, because rates were negative in the real sense, the genuine Fed funds rate. So you add 3 to 225, you get 525 basis points, way above the 400 basis points needed to engender a recession. And then you add on to that the QT, the quantitative tightening program from the Fed, where they sell their assets, which they've never before done, which probably added around another 100 basis points. You're over 600 basis points of Fed tightening. That could be a recession. We don't know if that's done yet. We don't see the yield curve rising yet, that spread. We don't see that happening. So later on this year, we could see that yield curve invert once again and head into another 2018, 2008 kind of event. So that's why you have to be people who are passively, I call them passively managed pigeons, they're going to get wiped out if they don't have an active model. If you want to suffer through another 2000 and 2008 when you lost half your money, that's your prerogative. I'm not going to let that happen to my clients. I'd rather forego. I'd rather make them a little bit of money safely as best I can, and then maybe even capitalize, protect their principal, and maybe even capitalize when this market falls and becomes a much more healthy environment for this country. I'd rather do that than try to buy the most overbought and extended market in history based upon a GDP that's ephemeral and tenuous. You could lose half your money again. And believe me, if you lose half your money again for the third time in the last 20 years, there's really no way you're going to ever be able to retire.
Why is Trump talking about the a 1% rate cut on one side, and then you have Warren Buffett saying, "Wow, the stock market is severely undervalued"? Somebody's wrong. Somebody is freaking out. Okay, Trump's saying, "I need 1% or 0.5%." Larry Kudlow was talking about 0.5%, then Trump comes out and says 1%, and they want more QE. And then Warren Buffett says, "Oh, this market is way undervalued."
Yeah.
Is it because we're going to get all that and it's going to hyperinflate? I mean, what's up with this?
Eventually, I will tell you one thing. It's going to be eventually one of those things. Two things that I mentioned is going to happen. You will eventually get a recession, or eventually you will get inflation, and you might, Greg, just get both. You might just get a huge case of stagflation to hit this country and around the world. That's what I'm most afraid of. And for that, you have to have a really fast, quick, intelligent, proven method of investing. I mean, you have to know when to buy your gold and increase your gold. By the way, we have a lot of gold already in the portfolio. We would increase that. You have to know when to get into your energy and when to get into real estate, because those would be your three things that would most protect you.
What's going on with gold and silver? What's going on with gold and silver? Gold's copping a little bit of a bit. It's still at 1280 something. Silver's below 15. What's up with that? A lot of people want to know.
Gold did not like what precious metals didn't like a few weeks ago was rising nominal bond yields. Nominal bond yields really started to spike when the Fed started to talk about turning dovish forever, and gold did not like that. But when you think about it, gold doesn't really worry about nominal yields in as much as they worry about real interest rates. So as long as inflation was rising faster than nominal yields, then you would think gold would get a bid. So gold is stabilized here, close to $1,300 an ounce. And I got to tell you, if you get, I was listening today to Vice Chair Clarida from the Fed talking about, hey, we keep undershooting our inflation target. We have to have 2%. Don't you know, if you don't have 2% inflation, the world devolves into nuclear meltdown. That's not really what's in the Fed's mandate. Congress gave them stable prices. But now stable prices mean 2% because you have to keep asset prices in this perpetual bubble, which I think I cogently laid out has to exist forever. Otherwise, the economy, the economy implodes. So they're going to keep on trying to come up with ways to reach 2.5, or maybe 2.5% inflation to make up for all those years it was below 2%. And they do that with modern monetary theory, where you just have to print money willy-nilly. You don't have to tax people anymore. Universal basic income. There's a push now even harder for negative interest rates, which they tried over in Europe and didn't work. But don't you know that's because they weren't quite negative enough. So I know you're going to have money in the bank, and the money in the bank isn't going to be. So suppose you have 100,000 in the bank. Well, you're not going to get 100,000 plus a little interest. You're going to lose, and I heard this morning on Bloomberg Radio. You're probably going to need to lose probably 5%. So you're going to lose 5% per annum on your deposits. So you better get them out of there and spend them fast. Oh boy, can I just say something? Thank God for outlets like you. You let someone like me, who doesn't have an agenda only to make money. I look at the facts, I report them to you, and there's an outlet like yours, USA Watchdog, where you can actually get somebody to come on and lay out his thesis and his scenario in detail, and not just come on and say, well, the summer is usually a good time for stocks, and earnings per share are still positive, even though they were 24% and now they're all zero, but that's still positive. Thank you for giving people like me this forum.
This will end, though. This has to end, and it's going to end
badly. Great. I hate saying this because I love this country as you do, and I don't want to be a Cassandra. I laid out the scenario as to why this has to end badly, because you have replaced the market. I mean, what is the free market? It's millions of people voting every day with their wallet as to what the price of goods should be, what goods should be available for purchase. We don't have that anymore. We have a government, worldwide, globally mandated prices in virtually everything, primarily with the cost of money, which distorts massively all of the other prices that are pegged off of that interest rate. That's why there's $10 trillion worth of negative yielding sovereign debt. A few years ago, the thought of going into debt and making money when you do so, it would be unfathomable. But here it is. And not just a couple of dollars, $10 trillion. Home prices are in an echo bubble again. Home prices are about 25% overvalued when adjusted for inflation. And of course, I talked about the stock bubble, where we're at almost 1.5 times GDP. GDP, by the way, that's false. That's artificially engendered by those low interest rates. So yes, this has to end badly because the distortions have to be reconciled. It was once okay to have recessions and corrections in the stock market when the stock market was not the economy. But asset prices have become the economy, and therefore they lead the economy. They don't follow the economy. So yes, it's going to end badly. I'm sorry to say. Unfortunately, yes.
The war card. I mean, you have all these. We're going to punish people who buy oil from Iran. And I'm not a big fan of Iran. I mean, I think the whole phony deal with the nuclear deal was a complete fraud. It wasn't signed. Documents say that from the Kerry State Department. It was not signed. It was a fraud. But what about the war card? You must be looking around the world and say, wow, things are kind of dicey in the Middle East with Iran threatening to shut down, the Gate of Tears, Bab el-Mandeb Strait and the Strait of Hormuz. It's a little, supposedly we got some kind of a warning that Iran was going to make some kind of attack on our forces in the Middle East, supposedly. A report.
Yeah, one of the things.
What about the war card? What about the
one of the things the neocons who have run? I mean, one of the reasons why Trump is unfairly attacked is because the neocons who run D.C. were worried that he wouldn't be pro-war. He was wanted to be friends with Russia, and he wanted to. He wasn't too enamored with having all these military bases all over the planet. That doesn't make Washington very happy. Unfortunately, I think he's been a little bit co-opted by the neocons who run D.C. And there's an aircraft carrier on its way to Iran in the Red Sea right now as we speak. Perhaps the war party in D.C. is leading the way towards pushing for tariffs for China, which I do agree should be pursued. So, we've had
if we get more,
an era of peace.
Does your model go to crap? If we get more, does it all turn to caca in a heartbeat?
Say again.
If we get war, does it turn to caca in a heartbeat?
Well, what I remember I said to you before. I said the two things that would kill the economy and the stock market are inflation and recession. If you get a war in the Middle East where oil prices spike well above $100 a barrel, then you'd get your inflation and a recession together. So the answer to that question is absolutely yes, unfortunately.
Michael Pento. Go ahead.
Before you sign off, can I just say one more thing?
Sure.
One more thing I want to just add is that what have we gotten? What have we derived from all of this artificial intrusion into markets, which really was stepped up after 2008? It started in 87 and was stepped up dramatically in 2008. Japan has no growth. There's no growth in Germany. There's no growth in Italy. We have an earnings recession here in the United States. So what you've engendered here is most likely a protracted period of stagflation, which is going to lead to an epic and massive crash in asset prices. That's what you have at your feet. So be careful. Even if you don't invest with me, even if you don't always listen to Greg Hunter, which you should, by the way, be cognizant of the fact that things are very dangerous, and try to avoid being overly greedy at this very fragile juncture in the global economy.
Good advice, Michael Pento. Thank you for joining us today on USAWatchdog.com. Again, Michael Pento, Pento Portfolio Strategies. I'll link to it. You're a prolific writer. You write a lot. You have podcasts. I think you have a free newsletter. Is that right?
I put out a newsletter almost weekly.
Is it a free? It's a free one, right?
It's free. The podcast is $49.99 a year.
Okay.
But I usually transcribe 75% of it in written form a few weeks later.
Fantastic. I mean, there's a lot of free stuff on Pento Portfolio.
A lot of research.
Pentoport.com. Pentoport.com. You're like a walking human. I put your brain against a computer chess player. I put your computer against Big Blue.
I don't know about that.
It works just about as fast and as well.
Thank you,
I really appreciate you coming on, Michael Pento. You never disappoint. Thanks for blowing the trumpet, sounding the warning that things are all not great and things could end badly in a hurry with the way they manipulated this market and this false, nirvana. But anyway, Michael Pento, Pento Portfolio Strategies. The link is going to be on the after the interview section and actually before. Michael, thanks for joining us today on USAWatchdog.com.
Thank you again, Greg.